Hey there, my name is Thomas, and this is For the Common. Thank you so much for watching this video and providing support on the channel. Really appreciate it. So over my last couple of videos, I've been talking about how margin in my account has absolutely crushed my portfolio. It's been a really tough couple of weeks. And is this video particularly fun to record? Not really. Do I feel like an idiot? Absolutely I do, and I've made a ton of mistakes, but importantly, I want this video and this portfolio reveal to be a lesson for folks out there who are thinking about margin, because it can be very dangerous, and hopefully this video will keep you from making some of the mistakes that I've made over the last several years. And that's really what For the Common, this channel, is all about. It's about a transparent view into the way that I'm managing my money so you can see some of the mistakes, but also see some of the successes and give you some encouragement that you can be a good long-term investor all by yourself. But a part of that journey is going to be making mistakes and learning from those. It's key really to investing. So that's why Thomas takeaway number one from the beginning has been that investing is a really humbling game. So this is a humbling video for me, but at the same time, I plan on talking about how I got in this margin pickle. I plan on talking about some of the pitfalls that I fell into, and as well, I plan on talking about what my plan is for using margin in the future, which I actually plan on continuing to use it. As well, I've recorded an introductory video about margin that I'll include above me here. And it really highlights what is margin, what are some of the cons and the pros about it, and what are some of the lessons that I've learned. And in this video right now, we're going to be talking about more complex margin topics. So if you're still a little bit iffy with margin, I would definitely check out the introductory video first. It'll help make this make a lot more sense. And as well, margin, it's not right for everyone. And really, this video is by no means a recommendation to use margin. Just because I use it does not mean that you should use it. And actually, you probably should not use margin. Margin is a really complex financial and investing tool, and it can make you lose a lot of money very quickly, and it can be very dangerous. So you have to be extremely careful with margin. And for most folks, it's not a good tool. It really is only something that should be used by the most experienced investors. And as well, another rule of the road that I like to outline for these reveal videos is that you're gonna have to do your own homework and make your own investment decisions. Do not do something or make an investment decision just because I make an investment decision. I make mistakes all the time, and I don't know your specific investment style or risk tolerance. So you have to be very careful to do your own homework and to make your own investment decisions. It's critical. And if you're looking for more disclosure on that, I have that in the bottom of this video description. So as I mentioned in my last portfolio reveal video, I had some personal circumstances that convinced me to take some pretty crazy positioning. But first and foremost, I want to own that the number one reason why I got into this pickle was because of me. I was overconfident, I made mistakes, I was greedy, and again, I was an idiot. So I own that, and I own the consequences of what happened in my portfolio as a result. But second, I was in a job that limited what stocks I could buy and sell, and there were certain companies that I couldn't sell. So it kind of set me up for a difficult positioning. And then third, we ended up buying a house. So I borrowed against the stocks that we owned to try and pay for improvements or for the down payment. That also added to the leverage. So where are we now, and how did I get here? Again, it was a confluence of those factors, but predominantly me being greedy and overconfident. And as a result, there were so many really amazing companies out there that I wanted to own, but there were those challenging reasons that I couldn't sell. And as well, I was overconfident. So I would borrow against the stocks that I own that were being successful and that were performing really well, and I would invest that into new companies without having to sell anything. So because of that, I just kept adding to really great businesses, and as a result, there was nothing that I wanted to sell. So I'm going to jump here into my portfolio. I want to show this chart here that shows the performance of my portfolio over time. And unfortunately, it only goes back to 2019. But before 2019, I had this investment style since about 2016 of focusing on long-term investing with really great companies and adding a little bit of leverage. And I had a lot of success. And that rolled into 2019, where you could see it did really well versus the index. And so that gave me confidence to continue to buy companies, continue to add some leverage and see what happens. And then COVID hit, and COVID in 2020 was just a absolutely astounding time to be an investor and to be watching the markets and to also be surrounded by other professional investors. I mean, the panic that was in the air was just so tangible. It was really wild. It must have been what it felt like during 2008. But if you think back to 2020, there were days that the S&P 500, the big index, right, or the Dow, it was down 10% in a day, 9–10%. That is a massive move in one day. And there were multiple consecutive days like that. So really incredible moves. And today we get upset about, 2% down days. These were 10. So something I will never forget. But as that happened and I was watching my portfolio, we got to the bottom, my portfolio went down substantially. I mean, probably close to 45–50%. But even with that, as we've talked, and I'll talk about some margin considerations, I survived that okay. I had still an okay buffer, not a lot, but a buffer that I could have taken a little bit more of a decline before I got into trouble. So this surviving COVID, which I thought would be a once in a lifetime type of market volatility move, it really gave me confidence that this model works. So I continued to lever. I bought more really good companies, and we also bought a house. So that made it more complicated from our financial picture. And I wasn't able to sell all the stocks that I wanted to. So it became this definitely, a mistake now, but a precarious position where I took on more leverage than I should have. But it worked really well for my portfolio for several years. So that's the hard part about investing, is that, something that's working now might eventually not work. And my bet that we would be entering a good economy year in 2022 and that the Fed rate concerns were overblown, I was absolutely dead wrong. And you can see that here in the result of my portfolio. I mean, I was absolutely wrong. And I had a big position in technology. So the portfolio peaked back in November. And then there were the real rumblings of worry around the Federal Reserve raising rates. That caused the first couple moves of my portfolio to go lower. And I hoped that having a diversified portfolio of really high quality companies would help save the portfolio over time. Because even though technology was taking such a big hit, I had other stocks in the portfolio that were doing fine. But I was wrong, because ultimately those fears around inflation and around the Federal Reserve made people very worried about a recession. And when you have people worry about a recession, that impacts all stocks, and all stocks really got hit. And I was hanging in there okay, but then the news of Ukraine. And of course, my heart absolutely goes out to the people of Ukraine. This is a terrible environment. And just seeing what's going on in the news is just absolutely tragic. So my heart is there, and it puts everything that I'm going through in perspective, because again, what they're going through is just an absolute nightmare. So my heart is with them. And with my portfolio, that volatility around the war is just really what did it in. So you had this another move lower, again, with oil prices spiking, with still fears of high inflation, and this broader concern that we were going to get a recession with the war uncertainty really made it tough for my portfolio. So I'm going to use this chart to zoom in to the most recent year, just to give a picture of that decline, and maybe interact with it a little bit more. And it is not a fun chart to interact with. Again, it's definitely a doozy. And all you can do is laugh because otherwise you'll cry. But it's been a rough one. I mean, from 2.1 million back in November, I mean, just absolutely really hurt by the rotation that I mentioned in technology, and then this most recent worry about, recessionary fears and obviously everything going on in Ukraine. So, if you look, as I mentioned in my last video, it was around the 23rd, 24th. That's when I got my first margin call from Interactive Brokers. And as I showed in that video, they were super quick to eliminate a big position that I had in Tesla. They sold about $80,000-$90,000, and that was tough because I'm a big fan of that company. Yes, I should have reduced that position size, some time ago, but Interactive Brokers did it for me, and it was difficult to see happen. So preemptively, as things, continue to get worse here into last week, unfortunately, I was faced with that same exact challenging situation where I had to decide. I've obviously made mistakes, and do I sit and let Interactive Brokers make the sale decisions for me and just ignore it, or do I have to face the consequences of the mistakes that I made and try and move on and be proactive? And that's ultimately what I had to decide to do. So as it got worse through the 7th, the 8th last week, and even into Friday, and now today's another really brutal day, I eliminated a large portion of my portfolio. Again, not because I wanted to, it's the last thing I want to do, but it's something that is mandated, that has to be done when you use margin and you ultimately get margin called. So I'm going to switch here to the portfolio. And this is a little bit of a different view. I ran a report here on Interactive Brokers that shows all the trades that I've done last week. So that's the 7th through the 11th. And you can see there's a long list of them. And trust me, each one was very, very painful. And really what happened, as I mentioned, is as things got worse, I knew I had to reduce leverage. I had to face the consequences of my decisions. And the way to do that was to sell companies that I had invested in. And the way I went about deciding what to sell, it was a very tough decision, but there's really two facets. And the first one was that a lot of these companies I had owned for a long period of time. So I was actually up in quite a few of them, and that's even after the big market decline that we've had. So if I go through here and I look through, the companies that are here: Accenture, Amazon, Boeing, Costco, CrowdStrike, Disney, Estee Lauder, Home Depot. These are companies that I really love and that I believe in. And unfortunately, I had to let them go because of my margin call. And again, it was picking the companies that I had a decent return in and that I could get out of without having too much damage. So I'll scroll down so you can see this. So the total of what I sold was around 700,000. So at the end of my last video, I had about 1.9 million in leverage. Now I've reduced that by 700,000 down to the 1.2 that it is. I'll show it here in just a second. And that originally the cost basis of what I paid for all of this stock was about 541,000. So I was up still 160,000, not, I guess, bad on 500,000, but at the end of the day, I was up way more back in November. And again, Zoetis, Visa, Union Pacific, T. Rowe, Thermo Fisher, S&P Global, Smart Sheets, Nike. These are really great companies that I was sad to see go. So I'm going to go here to the portfolio view, and you can see today is another really unfortunate day. And it's from a margin standpoint, like I said, I just mentioned that 1.2 million is what this is showing here in a negative cash balance, which is the margin account. And so the second way that I decided what to sell was that I wanted to concentrate my portfolio in the companies that I had the most conviction in. So these are the companies that I really believe are going to have the brightest future. And as well, because of what's happened in technology with this fear around rates and technology getting so negatively impacted from a stock price performance, a lot of the companies that I believe in the most are actually also down the most. So when I was looking across my portfolio, it was pretty clear to me that I was going to be selling the companies that had held up okay and that were doing pretty well in this volatility, and I was going to hold the ones that are down the most. And when I went through it, I've really, in my opinion, cut everything that I'd want to, and it was, again, already very painful. And we'll see. Right now, I've got about 539,000 in, net liquidity. That's certainly a far cry from 2 million. But the excess liquidity, what I have before I get a margin call, here's that maintenance margin number, is around 90,000. So that's what I'm down today. So it's possible I could get called tomorrow. And if that happens, then I'm going to have to make very painful decisions of cutting companies that I love, like Amazon, that's held up well. I'm still up 33% in that. Maybe Google, where I'm up 173%. Tesla up 90%. Some of those types of companies I would have to start trimming, or like Microsoft, which I've been adding to, I'm down 8%. Those are certainly more palatable than ones that are down maybe, here where Unity's down 50%, for example. So I have really concentrated the portfolio now in companies that I feel like are going to take advantage of the most impressive tailwinds in the economy, which really include cyber, which include cloud computing, data analytics, really that pocket of software and broader technology that I feel has an extremely bright future. So that's how I'm positioned now, really with companies that I have the absolute a ton of conviction in. Again, that's my belief. It may not work out that way. And again, if I get margin called, it's going to be tough making that choice around what's the next thing to cut, because it's getting pretty bare bones. But that's a view of the portfolio here that I wanted to share. So where to go from here? Yeah, it's been tough. It's been really challenging these last couple of months, and I've absolutely felt it. But all that being said, I'm so glad this is happening now. And the reason why is because I'm young. I have a long investment career ahead of me, but also I'm relatively new to YouTube. So I'm really happy that this is happening to me and not now when I have a greater following, right? So I can make that mistake, and that for you can learn from this margin, disaster, because these are lessons that I've learned the hard way now, and that's going to shape me as an investor for years, decades to come, having lived through this and now really understanding the challenges and the difficulties of margin. So I'm so thankful that I'm learning this now, and despite it being a tough pill to swallow, it's an important thing for me in my investment journey. So I want to touch on the takeaways that I've learned from this very challenging time with margin, and hopefully they'll be helpful for you. I outlined them in my introduction video about margin, but to cover them again, for margin, it's really, number one, it's really, really powerful, but it's also can be very dangerous. And as you've seen in my portfolio chart, that amazing run, it went from a portfolio of about 600,000 to 2.1 million. That was a course of 3 or 4 years. Really incredible. But as well, you saw the other side of that, which was the decline from 2.1 to now where I am below where I was before at around 550,000. So that double-edged sword of margin can really cut both ways, and you have to be extremely careful. The second thing, which I've learned, is that you have to be disciplined and you have to have a plan and stick to it. You need to set what's the maximum amount of leverage that you want to accept, and you can't go beyond that. And you can't go beyond it in the good times, because when the bad times hit, it's very, very difficult to unwind positions, because you will learn to love the companies that you invest in. And when they're down, it's the number one time that you don't want to sell. So it's very, very painful. And then as well, lesson number 3 is that diversification is key, and having a diversified portfolio really saved me. Being able to have companies that I've invested in for multiple years that were still up, even after coming off their high, back at the end of last year, that was amazing, because that allowed me to exit some positions and get more liquidity for my portfolio, but do that in a way that doesn't necessarily really negatively impact my long-term capital earning potential. What I mean by that is that if I had sold a company that was down 80%, I'm locking in that 80% loss versus these companies where I was still up 10, 15, 20, maybe 50%. Yes, it stinks that I had to sell them off their high, but at least I was able to lock in that gain and not this massive loss. So that's, again, diversification was crucial. And then the final lesson is that you have to be active in portfolio management if you're going to use margin. You have to really actively watch your portfolio, and when you start to feel these downdrafts or that margin and your leverage is getting too high, then you have to be active and you have to try and sell positions quickly, which is difficult, and you have to be a little bit more subject to market movements day in and day out. So that's something to be aware of too. And again, the 4 lessons that I've learned the hard way. So what's my plan going forward? It changes day by day. It's tough, and especially, today's market environment is making it challenging. So this is always changing. It's fluid. But the number one thing that I knew I had to do was reduce leverage, because I had to survive. I have to be able to survive this environment, stay with money invested in the market, so that when there is an equity market rebound, I'll be able to participate in that, and my portfolio will do well and rebound itself. So to survive, I knew I had to make some really challenging decisions last week and sell companies that I really love, really, amazing businesses that I have a lot of conviction in. And I left only the ones that have the utmost conviction in, the ones that I feel are going to be really great long-term performers over the next 5 to 10 years. And that's really where I concentrated my capital. I could be wrong, who knows, but at the same time, that's where I felt I would give myself the best position to rebound if the market does find a bottom. But if the market doesn't find a bottom, then I'm going to have to make some really tough decisions. Perhaps this week, perhaps next week, where I'll have to sell some of those ones where I have the utmost confidence, which will be very painful. And this whole experience has been painful, but that's the plan. Now, if things do bottom and there is a recovery, then my hope will be to reduce leverage just a little bit more, down from 1.2 million that it is now, down to $1 million. And why $1 million? 1, because it's a round number, but 2, because I want to keep leverage in my portfolio to be able to participate in any sort of rebound, and that will help my portfolio recover faster. Again, if things get worse, then I might have to sell more stock while it's down, which is painful, but I'm taking that risk with the expectation of a rebound. And then from there, I have to stay disciplined. My plan will be to stay at that $1 million leverage level for a while, and I won't buy any more stock. I won't borrow any more money against the account unless I sell something. So I'll have to force myself to sell something to either pay for a new investment or pay for an expense. And so that will hopefully keep my leverage more stable into the future. And then what my goal is that once my portfolio reaches 2.75 million, 2.75, then that's when I can increase my leverage from 1 million and beyond. And I'm going to explain now why that number is important to me. And that's because of a leverage ratio that I'm targeting. So let me jump back to my computer and explain that. So the question that's hard with margin is, what's the right amount of leverage? Should you get $5,000, $10,000, $100 million? It's really hard to know, but there is a way that I've thought about it historically that I think might be helpful. And as I mentioned, it's this thing called a leverage ratio. And I'm going to explain it now. And I know it sounds totally crazy on my 2.75 million, but I want to try and walk through it here and then I can explain it a little bit more. But we covered this yesterday, and sorry to bring back the PowerPoint, but I know that leverage in margin is complicated. So again, if this math looks foreign to you, I would recommend looking at my introduction video that I covered, that I've mentioned in this video a few times. But so the maintenance margin requirement is 25% of your total account value. That's what we've talked about. The way that you calculate this leverage ratio, and it's the way Interactive Brokers does it, is that you take that total asset asset value of your account or your total account value, and you divide it by equity. So let's take that same example that we've been using with the 10,000 equity and 5,000 debt, and that's the 15,000 total account value. What's the leverage ratio, right? So if we look at that, you've got, again, the same 10,000 in equity, 5,000 debt, 15,000 total. So you take that 15,000 total and you divide it by 10,000, and that gives you a leverage ratio of 1.5. So what would happen if you had a leverage ratio of 2? What would that look like? So example 2 here shows with a leverage ratio of 2 that if you had $10,000 worth of equity and a leverage ratio of 2, that would mean that you have $10,000 worth of debt or a total account value of $20,000. And to work that math out below, you've got that $20,000 total, divide that by $10,000 worth of equity, and that gives you the 2.0 leverage ratio. So before this happened in November, my account was at a 2 leverage ratio, where for every dollar I had of equity, I had a dollar of debt. That was a lot. So that was 2.1 million of equity. That meant I had 2.1 million worth of debt. And when you have that high of a leverage ratio, it means you can't really survive too many significant market declines because you have so much debt. And so leverage ratios for me historically have been good ways to think about if the market hits a rough patch, how much downside can I survive before I get margin called? So I want to go back and talk about, I mentioned when COVID hit, and I had a leverage ratio of right around 1.6. So here's the information I shared in the last slide, but with a 1.6 leverage ratio, what downside can you take? And the math is, again, a little complicated here, but I want to walk through. It's super important. If with a 1.6 leverage ratio, if you're saying you have $10,000 worth of equity, that would be $6,000 worth of debt. Again, that's the 16,000 total divided by 10. 1,000, that would give you the 1.6. So this is your portfolio makeup, right? So it's more debt than the examples that we've talked about before. So if you have $16,000 in total account value and it falls 50%, that's a big decline. Your account value, your total account value will drop to 8,000. So again, that's 16, cut in half. And then to figure out what your minimum requirement is, you multiply that total account value, which is now 8,000, by 25%, which is the minimum set by the Federal Reserve. Again, your broker might be different, so you need to double check. But in this scenario, 25% of 8,000 is a $2,000 minimum requirement. So you have to stay above that amount in equity or you'll get a call. So are we going to get a call if the market fell 50%? Well, if you had $8,000 of a total account value, right, it fell in half, and you had that $6,000 of debt, which we outlined at the beginning, you'd only have $2,000 in equity. And so you have $2,000 of equity and the minimum is $2,000, which means you would be margin called, but just barely, which for me indicates in this math that you can survive about a 50% decline with a 1.6 leverage ratio before you get margin called. 50% declines can happen a lot, and it's difficult because when you add leverage, your account will actually fall faster. So is it possible that the market could fall 30% and your account could be down 50%? Yeah, absolutely. And that's what's happened to me now. So when I'm looking in the future and I'm trying to figure out what type of decline do I want to try and survive and what's the right amount of leverage for my portfolio, I keep coming back to this number of about a third or a 1.35 leverage ratio. So for that example, if you have $10,000 worth of equity, that means how much debt you need to get a 1.35 leverage ratio would be about $3,500 worth of debt. So your total account value would be $13,500. So again, you have to do some trial and error to figure out if it's a 60, a 70, a 65, 50% decline, what kind of decline can you survive? And I've done that math. And for that $13,500 of total account value, if it was to take a 65% hit, big hit, that would drop the value down to $4,725 of total account value. So that's brutal, right? You've lost a lot of money. But are you going to get a margin call? Well, you multiply that 25% requirement by the total account value, which is $4,725, and you get the minimum requirement of $1,181. Are you going to get margin called? Let's see. Total account value is $4,725, and you had $3,500 in debt. You actually have $1,225 of equity. So if you look down this bottom line, that equity number is above the minimum, so you're good. So for me, what that means is that my portfolio can take a 65% decline at a 1.35 leverage ratio before I get a margin call. Now, if I was to use, again, math, and I say that I have $1 million worth of debt, what's the number of equity that I have to equal a 1.35 leverage ratio? And I didn't outline the math, but I can, surprise, the number is $2.75 million. So with $1 million worth of debt, you have to have an account worth $2.75 million for you to have a 1.35 leverage ratio. So that is my plan. I want to keep leverage in my account to participate in any rebound in the market, but I've made a commitment to myself, and this video will be that reminder that I will not increase that leverage ratio or that amount of $1 million until my ratio reaches 1.35, which means my account has to grow to 2.75 million, and at 500,000 right now, I have a long way to go. And so that's my plan. You got a crazy plan and a crazy market married with a crazy portfolio allocation. Seems to make sense, but this market is super fluid and it's changing every day, and who knows, in a couple days this might all go out the window because of a margin call. So it's tough to know what's going to happen for my portfolio over the next several weeks, but I'm hopeful. And the number one thing for me was that I had to face the consequences of my decisions, which was having a lot of margin in debt, and ultimately I had to sell a bunch of companies that I really liked to reduce leverage and survive. So I want you to feel the pain in my voice. I mean, it's definitely there, and we've seen the pain through my portfolio, right? Massive decline, and it's not easy to go through that. But the important thing for you is that if you're thinking about margin, or if you're thinking about, dabbling in it, you've got to be careful. It can really get challenging quickly, and you can lose a lot of money because of margin. So better yet, don't use it. Investing is really hard already, and unless you're extremely experienced, margin can make things just so much more complicated. And it took years and years of using margin for me to get this level of comfort and understanding of it. So it takes a lot of time, and you just have to be careful. If you decide to use leverage, again, be cautious, but importantly, the things that I say might not be right for you with respect to how much debt you take on, your leverage ratios. So keep that in mind for your own risk tolerances and your objectives. You've got to do your own homework, and you've got to make your own investment decisions. And just because I'm doing something a certain way does not mean it's right for you. So please keep that in mind. Hopefully the video was helpful, and I really appreciate you taking time to watch it. If it was helpful and you got some use out of it, I would really appreciate a like or a subscribe to the channel. It means a lot to me, so thank you for that support. And we'll be back with another portfolio reveal video. Hopefully I have a smile on my face from a rebound, but we'll see then. And again, I appreciate it. Till next time. I'm gonna get called. No, I'm not. Not today. It's gonna be a rough market, man. Hey there, my name is Thomas.